Good afternoon. This is Adrian Mueller from Time Leverage Capital. I am the principal of this firm, and I am the developer for the Option Ranger software that we're going to be demonstrating. First and foremost, by way of disclosure, and when you do register on the site, in order to be able to access the Option Ranger, you're going to go ahead and read this full disclosure and agree to it. The principal points I want to make about this or any educational material in trading is that we are not going over individual trading advice for anybody. So just because we're going to do a discussion of selling puts and the situations under which this might be a theoretically good idea, it doesn't necessarily mean that it's suitable for everybody. It's a margin trade, so you should really understand these trades and make decisions not just based on market factors, but even more importantly on your personal financial situation, risk tolerance, and investment objectives. So if necessary, be sure to set up, if you don't have access to quotes and a platform, be sure to get set up with us for a platform where you can get quotes and place trades and monitor these results. Today's discussion wraps up our series on the 4 basic strategies of options, which is buying calls, buying puts, selling calls, and our final selection today is selling puts. Bear in mind that if you haven't seen the previous segments in the series, as well as our discussion on volatility and risk, please be sure to check out our demo section where you can see some demo videos on how to input trades. Be sure to check out the dynamic option strategy gallery in which the parameters for selecting trades are discussed. When we go to the strategy gallery today, we are going to be looking into selling a put, or as we phrase it here, shorting a put. The 2 principal factors that are used on this grid to decide a trade are the following. The first, and this is one that is very commonplace in the thinking of investors and speculators alike, is direction. Which way is the market going? And it's fairly obvious that the outlook on that can either be bullish, meaning that the markets are going to go up, bearish, that the markets are going to go down, or undecided. That a person doesn't know where their markets are going, or they think they might go strictly sideways. In certain cases, even an investor or a speculator that is undecided about direction, as you can see, still has strategies that they can develop based on the other major factor in picking a strategy, which is the volatility outlook. So first of all, we have the direction, up, down, or sideways, and next we have our expectations of volatility. And again, similarly, we're talking about volatility going up, volatility going down, or volatility being undecided. So in this particular case, we're going to come up with a scenario for a trade that is actually among the more popular of option strategies, which is the selling or shorting of a put. Your outlook in that scenario is dual in nature. Number one, it is a directional trade. So if you are selling a put, this is one of your alternatives, one of your strategic possibilities. If you want to be bullish the market, you think the market's going up. If you want to make a more subtle decision or perhaps a more targeted decision with a broader outlook, and you understand how to sell puts, that is one way of being bullish. The time to do this as well is when volatility is falling. So again, you have 2 outlooks. Number one, that the market is going to go up, or actually, depending where you write the option, stay flat, or that the market volatility is going to go down. If it's very excessively jumping around, as we might say it has been in the last couple of weeks, the volatility is up, and you might say this market is going to quiet down. That would be your expectation that volatility is falling. When trading options, when investing, when speculating in anything, you need to be very mindful of volatility. Certainly a major option in factor in options, but also in any investment. If you buy something 4 times and it goes up a little bit, that's okay, and then you buy the 5th time, you could lose a whole lot. So you could say I have 4 wins and 1 loser, but what matters is the volatility, the size of the move, the extent of the move. So one way of measuring risk is thinking how volatile is this market going to be. So in this particular case, let's go ahead and click on it as it's available in our strategy gallery. And when you click on a strategy, you get the immediate outlook for the trade. As long as other convenient links, in this particular case, you see the outlook that what you can make is the premium that you've collected. And we have a much more user-friendly way to see this very soon on the software. And you use it, again, as we said, if you strongly believe the market will go up or will not reach your strike price at any time during the life of the option. So what you're really looking for here is for the market not to go down in a big way. Your enemy when selling the put, which is a margin trade with unlimited risk, your enemy is a large move down, a move down with rising volatility. If the market is flat or it goes up, you're in good shape. In this case, because you're collecting premium, barring any major move against you, time erosion works in your favor. So this option will erode, and we're actually going to show you the erosion table here, which is very theoretical looking, is one that we are going to show you on an actual spreadsheet so that you can evaluate the numbers. Again, I will remind you that selling a put is a margin trade, and you have to make sure that you have the necessary funds to cash settle the position, or in certain cases certainly in the case of stocks, you can take the stock. The stock, as they say, gets put to you. And this is a strategy for people to collect premium. And if they want to own a particular stock at a given price and have the finances and the desire to own that stock at that price or below, then they would sell that put. They would either keep the premium if the market doesn't go there, or get the stock put to them and they own the stock. This is somewhat different in futures, because in futures the time frame between the exercise period for the option and the closing out of the contract is not as long. So if you take that position, so to speak, it may be a short-term position unless you decide to roll it forward based on your ongoing opinion. When we look at these particular strategies, again, you have a narrative of the trade details, and for those of you that are still getting familiar with the terminology, please be reminded that we have reference materials, so you can go to our option sheets where you're going to have a further discussion. You're going to be able to go to our demo videos where you can see some of the inputs on some of these trades and a further and more detailed explanation. So now let's go ahead and see a couple of examples on selling the put. Again, this is the graphic that we just reviewed. And now let's go ahead to the option ranger, and to save some time, we've actually input some trades. For those of you who are not familiar, this tab enables us to save trades, to put in trades with a date, with an amount, and then we can look at that trade and follow the results. And we also have customized tabs, and today for our purposes we created a tab for selling puts to open, which is what we are discussing today. Whenever we input a trade, and in this case we're going to look at let's go ahead and start out with the crude oil market. The way to input a trade here, and we have a demo on how to do it, is we input the crude oil market, selling a put at 87, selling a put at 87 for a premium of 62 points. Like any good business, we input a cost factor, a default cost factor, and as this information gets input, you will see that all of these boxes open up. So in the case of crude oil, you get crude oil, you get the detail on the contract specs. So the minute, let's go ahead and reset this, and I will put in the trade again just to show you how simply this works. Let's say in this case we're working with crude oil. There's a drop-down menu where you can select your contract, or you can start typing in your contract, and you are taken to the particular contract. Again, here there is a mini crude oil, and we have input those values as well. The moment the market is entered, you get a dialog box that opens up. It's a help box. It gives you the tick values. And in case you want the full contract specs, this intuitively takes you straight to the contract specs. You click on that, you get the contract specs for the market. And in the right-hand column, something that I've developed over many years working with Dow Jones News, are some of the key factors to watch and to think about, not only before you put on a trade in the crude oil market, to use this example, but in any given market. So here we've listed over the years some of the key factors. Department of Energy weekly report, the API report, very important. And you have a link from here that will take you directly to the primary source where that report is located, or you can look for our updates by email as this information come out. I also find the Commitment of Traders report to be extraordinarily helpful, and we will certainly do some programming on that as a primary source for making a trading decision. This kind of grid of what to watch, and also the contract specs, is available on all markets. So again, just to make the point, when we enter crude oil, we get access to all that information to consider the trade. Today, our strategy that we're doing is selling a put. Now you'll notice that the minute we input selling a put, the profit and loss graph appears. And again, the profit and loss graph is a reminder. Intuitively, it's very hard for people to immediately get a sense of what this means. So you can click on this, which will take you to the selling a put detail if you need a reminder. And here you have the key reminders, ingredients of the trade, that your direction is up and your volatility outlook is down. So you're looking for this market either to go up or to be very tame. So now that we've had this reminder, again, we have a dialog box with intuitive access to the detailed description of this trade's parameters. And then, of course, as we did before, let's go ahead and do one position. In this particular case, and we're using an example on crude oil, you saw we had the contract specs. The minute we click on the strike price, this is one of the areas that people have to get a little bit used to in terms of understanding options and which options to trade. The moment we click on strike price, again, the dialog box opens up. It gives you a way to input the strike price, and if there's anything that you want to clarify about selecting a class of strike price, other than talking to your broker or whoever is working with you, you can click on the Learn More button, and you will get a discussion of in, at, and out of the money options. And remember, you can also still go to the reference section that is available here, along with the demos and the option sheets. So now we're going to input a price, now that we know how to do it, of 87. Okay, which would be for crude oil to be trading at $87. At $87. Okay, and so the expectation of the person who does this would be that the market will somehow hold above 87 or actually go up. The premium that we had here, and I'm just inputting it again for purposes of illustration, was 0.62, and again we have indications here on how to enter the premium, because tick values are different in all of the markets, and by having these inputs you can do the math around Any contract, corn is in 5,000 bushels. The crude oil contract is 1,000 barrels. There are variable sized contracts on which you can do the math, and this will be a safeguard against miscalculating, getting the right numbers to gauge your risk zones and the areas for which you are expecting market moves to materialize. And then let's go ahead and put in a default cost on the transaction, and then we calculate. As you can see now, we get a real profit and loss on the intrinsic value of this option, where it goes in the money and how it loses, and how it gains depending on the circumstances. In this particular case, we get a summary of the trade. We're selling a put at 87 for about 62. This would be a May put option. I've done the research. So somebody here is basically thinking that they're going to collect $620 minus their fees. You have to do your cost of doing business. This would be a net credit after commissions and fees on that structure of $565. We get a reminder of what the crude oil contract is made up of. It's 1,000 barrels at $10 per tick. So the value is $1,000. The math is simple. Let's see where we are. To make it even more straightforward, let's see where this trade makes money. Well, as we spoke, if the market goes up to any number, objectively, you've collected $565. That's the most that you can make. This is like a premium transaction. Your risk obviously begins if the market tanks under 87 by more than you've collected. To make this calculation easier, we have the break-even box here at the top. So right after we go over the debits and the transaction costs, you have a futures break-even point, which is 86.44. That means that on expiration date, if the market is at 80.44, you've broken even after your costs. So you have a margin of error. You have a margin of error for this market to drop from the current price of 96.72. 96.72. It would have to drop over $10 by the May expiration in order for you to incur losses. However, this is a margin trade, so for every tick that it moves under that 86.44 level, now you would be not only having paid back the $565 net that you've collected, but you'd lose $10 a tick all the way down. And as you can see, although you have a nice margin of error of $10 going down, if there's a very large move to the downside, the losses increase. So for instance, at a level of around 84.5, you would be the position would be down almost $1,900. Now, on the other hand, if a person is confident that the market's going to go up, or that the market is not going down, that the volatility is going to go down significantly, then they would, assuming that they are suitable to do so, they might be willing to take that risk. One of the things, and again, for the margin and for the time frame and for the cushion of error, you know, people that like to write premium will take this kind of risk to reward ratio if it's suitable for them. The next example that I wanted to go to in our grid, and then we can make up one of our own if we have a request. Excuse me. Just a moment. Let me just bring back those. We have multiple calculators, and what we are looking at right now is the futures basic option calculator, because we're just working on the four strategies. We have spread calculators. We also have a stock and stock option calculator. And again, if you want to track these prices and update these values, or in here, or have us update these values, be sure to set yourself up with a simulation account. Now, let's look at another transaction. I spoke earlier about the possibility that some people use in order to simulate stock transactions using the sale of puts or the S&P index. So as you can see here, we have a different transaction. Here we're looking at something in the S&P 500 index. Again, we see the fundamental graphs of the trade. Our direction is up, our volatility expectation is down, and we are looking, this was the value I saw in that put earlier today for 10 ticks. So this person thinks that the market is going to stay above, the S&P is going to stay above 1,650, above 1650. It is presently at 1767. So it would take another 117-point drop in order for this option to go intrinsic. Of course, at this moment we're at 3:47 p.m. on February 6th on Thursday. So of course that number can change, but that would be the size drop that is presently being factored into the premium and into the volatility, that a writer of premium basically says, I don't think the market is going to go down 117 points to 1650. And if they have that opinion, they want to see, well, how much can I make on that opinion, and what is my risk if I'm wrong? They input the trade. This is the large contract. There's also a mini contract that we can look at based on the risk to reward ratio. Now, on 10 points, based on the tick values here, we're talking about collecting $2,500. That's $2,500. We see here that after costs, the net would be $2,445, $2,445 collected at the beginning of the transaction. This is a margin trade, so you have to have a margin account to do that. Your futures break-even points at expiration date, as long as the futures are above 1640.22, you've broken even, and the higher it is above 1640.22, the more you make. The premium break-even that you can monitor anytime, because that's an ongoing volatility-based calculation, is 9.78, factoring in your costs. So if you're tracking premium values and you say, well, when can I take a profit on this position? If you collected 978 and you find out that it's trading for 5 or for 4, you take that number, you multiply it by 250 and see if what the position is worth makes it worth your while to offset. So you don't have to wait till expiration for the market to be at 650 or below. You can offset this position anytime. You can put this position on any time as prices fluctuate. Your break-even on premium is going to be 9.78. Your risk, again, as I said, this is a margin trade, so it's going to be $25 per tick intrinsically, either under that 1640.22 at expiration, or 25 per tick intrinsically above the premium that you pay, above the premium that you collected of 9.78. So you should watch the futures price, but even more importantly, continue watching the premium price and the volatility. At expiration, as you've seen, this is an outlook that is a bullish outlook, you're selling a put, the real gain, the obvious gain, is if the market goes up or even stays flat. For instance, look at this. If you're talking about the market being on expiration date at 1650, which is 117 points lower than it is right now, and you were so wrong about your upside direction, you would still, at expiration, above that price, keep your 2,445, because this is handicapped with volatility. So although your directional outlook in this case would be wrong, the market goes down to 1650, 1670, 1660, and you thought it's going up, because the volatility fell, meaning it didn't go there fast enough, you could end up still keeping that premium. That's the reason people sell out of the money options. The reason there is a premium that is that big to be collected is because if the market breaks under those levels, as you can see, the losses can build up pretty quickly. So while you have a good margin of error, and an eroding asset that's working in your favor. If something happens, the market breaks down, you end up at 1620, you'd be down 5,055 intrinsically, or if the option was trading at that value as well. So where you're looking at here is a trade in which you have to have a reasonable amount of confidence that the market is either going to go up or that it's not going to make a hugely volatile to the downside move, as would be needed in this case. When people look at charts and they try to decide, how do I know if the volatility is high and it's worth taking this kind of a chance, first and foremost, they have to look at their own suitability. Secondly, you can look at a chart and make all kinds of interpretations about where the market's going and whether or not that trade looks favorable. So let me just pull up a chart now, and this chart does not suggest necessarily to me that you want to sell a put, but I think it does give us an idea of what kind of thinking would go into this, and I especially want to show you two of the factors that count. We are looking at a daily chart on the S&P. As you can see here, and there are multiple indicators, I'm sorry, this is one of the templates that I use, but one of the things that you see is that usually if a market gets into a very wide standard deviation, these are Bollinger Bands, when there are very large moves. So here in this time frame you had a very large move. The standard deviation on high volatility went up. And then the market, at least for a short time, adjusted into a more narrow period. So volatility went up and then it went down. Then you see another period of rising volatility and then some sideways movement. Here again, where you have the biggest bands, the biggest standard deviation, in some cases you have, as you can see, a flattening out period. Then again, the standard deviations increase and then they narrow. Volatility, if you look at the VIX index that we discussed before, is very important to follow. Here you're actually looking at it and you see that it's still pretty high. When we did a program on the VIX last week, we suggested the VIX, which is the volatility index, as a way of tracking and also hedging or trading these markets. And the VIX and the volatility tend to be higher. They tend to be higher when the markets go down. We have a whole grid on the volatility. So if you're in a situation like this and you say, well, I think this chart looks weak, and you look at the type of drop that can materialize here, and you might say, well, you know, it's really not worth it, because what if I'm wrong and the market gets down to here, and you do your math and you realize that when you put it next to the option chain, it doesn't work for you. So you would have to have an expectation of the market really holding, you know, within a reasonable area. And if I may, so whether a person picks this level or picks another level, you have to make sure that your spreadsheet measures up. One of the things that we try to do, that I try to do again, sometimes to make this easier on the brain, is to put side by side, just a moment, a chart to get a sense of price area, and then go right back to the option chain, so that once you select a zone where you think a market's going to go, so let's say if you thought you had a top of 1840 or you had a bottom of 1620 or 1640, then you can go directly to an option chain, locate a price on your option chain, and then of course immediately thereafter you can go in and input the price on the option chain and see whether or not what you observed on the chart translates into a good risk to reward ratio when you work up this particular graph. So again, one of the things we did want to show again is the importance of being able to assess risk. So let's say if somebody who did the large S&P contract was uncomfortable with the level of risk, they might go ahead, and we already input this, and change to maybe having 2 of the E-mini contracts, which are 1/5 the size. They're $50 times the index. So when you look at that measurement on 2 positions, On the E-mini, the potential gain is less because it's a smaller contract, so you're collecting 1,000 instead of 2,500 on the position. Then, of course, you subtract on the two positions. Then you subtract your costs, and the most that you can make, the number has gone down significantly. The most that you can make now is $930 after costs. $930 as opposed to the 2445 that we were looking at before. However, by the same token, again, you're only making $930. You have a lot of room to drop. Your break-even number is up in the dialog box. Your break-even on futures is 1640.70. Your break-even premium on the options that you can get quoted anytime is 9.3. And again, one of the reasons somebody might do a smaller position instead of the large S&P contract and do two small ones is because the level of loss is lower on a drop. So in this particular case, we had shown before that a move to 1620 was a pretty significant loss. Here you're looking at 2070. Again, not a happy environment, but a much lower risk. And this is one of the things that I kind of like about comparing trades this way, is you can literally just go back and forth by clicking on the box, check out different numbers and decide at which number your risk tolerance is okay and which type of reward is sufficient for you, and experiment with different numbers. You might turn around, you can change a strike price and zip back and forth between those. If we want to make a change, let's say somebody says, okay, I'm going to do I'm still uncomfortable selling puts in the E-mini, but I want to do it, the volatility's high. So let's say the person who sold two E-mini says, you know what, I'm just going to sell one. I like people who are careful. Less to make, less to risk, and always something to learn. So we calculate that new trade. You don't have to input everything else. And then we see the difference between a 2-lot and a 1-lot. Now it's a real it's even less to be made, only $465 net after costs. However, you still have that nice margin of error on the upside. And if the market drops down into that 1620 range, that'd look pretty nasty. Now the loss would be $1,035. And even as you go into larger and larger drops, the number is very different. So deciding your leverage and position size is very important, and this is a very quick way to make a comparison. If you also want to make a change, and this may not even be a real price, but I just want to go very quick. Let's say somebody says, okay, you know what, I'm going to be careful and take this down to 1630. I want an extra 20 points of cushion. Now let's say if that option were trading for, let's see what it's trading for. Okay, just a moment, 1620. Okay. Okay, let's call it 6.75 was the last trade. Okay. So we have a way of inputting premium. So let's go ahead and do that, 6.75. Everything else stays the same. We still just sold one. And let's see how that number works out. Again, now we've only collected $337.50. Oh my goodness, is it still worth it? But when you look at the margins, you have the room here. I'm sorry, 302 after costs. But although you're keeping significantly less, you have a big margin of error, and at that 1620 level, which is a pretty big drop that we looked at before, now the trade would be down under $200 intrinsically at a futures expiration, and your premium break-even again would be a different break-even. You have a break-even premium of 6.05. So when you look at the futures, what you also should do is be sure to look at your platform or ask for a bid and ask on the option premiums when you deal with our folks here at TLC. So what we could do is, what you can do here is build these up. As you can see, when you save these trades to a tab, they're always dated. You can always open them immediately, and you can do a comparison of transactions. If anybody has a question at this moment, I'm going to be wrapping up in a few minutes with some more comments. So if you do have a question, please type it into the dialog box or into the chat box, or email it to us or to our trading desk sometime later in the day, or to the Option Ranger customer desk, and we will be happy to accommodate you. Finally, to finish this beginning portion, let me go back on a broader scale into the strategy gallery to discuss this type of strategy. When we are talking about selling calls and selling puts, and let me just go back in here. When you're talking about selling calls and selling puts, you're always looking at a situation in which you have an outlook of falling volatility. This is called selling premium. Whether you sell a put, which means you think the market's going up with falling volatility, or whether you sell a call, which means that the market's going down with falling volatility, your expectation is that the market's going to come down in volatility. If you don't have that volatility outlook, then this just may not be a trade for you. You can do a purely directional trade. On the other hand, when you do have a belief in rising volatility, as you can see here, on a bullish direction, you buy a call, and on a bearish direction, you buy a put. In this case, you are looking for rising volatility. You are looking for greater excitement and greater anxiety in the market, which will build up which will cause the premiums to rise, which is your objective when you buy premium. So bear in mind, if you're long, if you're a buyer of options, if you're a buyer of premium, you're looking for upside volatility moves. You're looking for excitement, panic, ranges of trading to go up. If you are looking for ranges of volatility and panic to go down, whether on the upside or the downside, you're going to be short premium. You're going to short calls. You're going to short puts. So again, when you're a writer of premium, you're looking for diminishing volatility. When you're a buyer of premium, you're looking for rising volatility. And that is your parameters for deciding on the 4 basic strategies whether you buy or write calls. For more subtle positions as to directional outlook and for modulated ways of adjusting trades, we are going to start going over our master combination calculator next week, where we are going to try to take advantage of discrepancies, if possible, in values or of certain ranges of charts in which we can combine what we would believe to be well-priced or underpriced options that we can purchase with overpriced or volatility-skewed overpriced options that we would write. So what we have learned now about premium, rising volatility and falling volatility is going to be a key ingredient in going to the next step on how to use them in combination in spread and combination strategies. I want to thank everybody for attending. Please don't hesitate to ask for our supporting materials and also to use our reference materials to get a better understanding. It takes practice. I've worked at this for many years, and I know even professional brokers that I've trained or that we've worked with, it takes a certain amount of homework and effort to fully understand these strategies, but it's well worthwhile. Again, before I close, I want to remind you that trading futures and options involves substantial risk of loss and is not suitable for all investors, and past performance is not necessarily indicative of future results. I congratulate all of you for attending, for becoming more educated about trading. Be sure you know what you're doing before you put your money on the line. And if you have any questions for us, don't hesitate to contact us. Thanks again for attending, and have a wonderful Thursday.